Hello and welcome to this definitive masterclass. Today we're embarking on a comprehensive 10-minute deep dive into accurately identifying market trends. Whether you're a day trader or a long-term investor, understanding the trend is the difference between riding a wave and being pulled under by the tide. So, what exactly is a market trend? Simply put, it's the general direction of price movement over a specific period, be it upward, downward, or sideways. Trends aren't random noise. They are the footprint of institutional sentiment, economic fundamentals, and global macro forces aligning together. Why does this matter? Because many retail investors fall into the trap of reacting to every single news headline or minor price fluctuation. This emotional reactivity often leads to FOMO, buying at the top, or panic selling at the bottom during a temporary pullback. Think of it like a game of poker. You don't need to win every hand, but you do need to know when the odds are stacked in your favor. Let's look at the tools. The first tool in any professional's arsenal is the moving average. These indicators smooth out the daily volatility to reveal the true direction. Next, we have trend lines. These are the geometric boundaries of the trend. In an uptrend, we connect the higher lows to find our support level. But how do we know if a move is real? We look at volume. Volume is the conviction behind the price move, telling us if big money is participating. We also use momentum oscillators like the RSI. This tells us if a trend is becoming overextended or if it still has significant room to run. The final piece of the puzzle is multi-time frame alignment. Professionals never look at a single chart in isolation. They zoom out to see the forest. Now, tools are great, but how do we get visual confirmation? We look at candlestick patterns. These are the language of the market. A bullish engulfing pattern at a support line is a powerful signal. It shows that the buyers have completely overwhelmed the sellers. Then there's the hammer. This candle shows that even though sellers tried to push the price lower, the buyers stepped in and reclaimed the ground. Conversely, a shooting star at the top of a trend warns us that the buying pressure is exhausted and a reversal may be imminent. Never trade a candle pattern in isolation. You want to see these patterns forming exactly at key levels like trend lines or moving averages. But what drives these trends? It's not just lines on a screen. It's the why, the macro fundamentals and market sentiment. The biggest trends are often fueled by central bank policy. When interest rates are low and liquidity is high, the tide lifts all boats. Economic data like inflation reports and employment numbers act as catalysts, either confirming the current trend or sparking a new one. Finally, there's market sentiment. Trends persist because of human psychology, the alternating cycles of fear and greed that drive all markets. This brings us to a critical strategic choice. Should you be a trend follower or a mean reversion trader? There's a big difference. Trend following is about buying high and selling higher. It assumes that what is in motion will stay in motion until a clear signal says otherwise. Mean reversion, on the other hand, is about betting that a move has gone too far and must return to its average. It's often much riskier. For most investors, trend following offers a superior edge. It aligns you with the institutional smart money and provides better risk-reward ratios. Now, even the strongest trends eventually end. Identifying a reversal early is how you protect your hard-earned profits. One of our favorite signals is divergence. When the price makes a new high but our momentum indicator fails to follow, the trend is losing steam. Then we have structural patterns like the head and shoulders. This shows the transition from an uptrend into a new downward phase. Look for climax volume. A sudden, massive spike in volume after a long move often signals the final exhaustion of the trend. Do trends look the same everywhere? Not exactly. Let's compare trends in stocks, forex, and cryptocurrency. Stock market trends are often driven by quarterly earnings and company-specific fundamentals. They tend to be more stable over the long term. Forex trends are driven by interest rate differentials between countries. Because currencies are traded in pairs, they often spend more time in ranges. Cryptocurrency trends are the most volatile. They are purely sentiment-driven and often become parabolic much faster than traditional assets. The final step is to combine all these tools into a repeatable system that works for your personal goals and risk tolerance. Before you trade live, you must backtest. Look back at historical data to see how your chosen trend tools would have performed in the past. Keep a detailed journal. Document why you entered the trend, how you managed the risk, and what you learned from the outcome. Markets evolve, and your system should too. Continuous learning is the hallmark of every successful professional trend follower. A professional system is defined by its rules. You need clear criteria for when to enter a trend and, more importantly, when to exit. For your entry, wait for a breakout followed by a successful retest of the previous resistance. This confirmation significantly increases your win rate. Your exit should be just as mechanical. Whether it's a break of a trend line or a technical target being hit, never negotiate with your rules. As we look to the future, AI and machine learning are becoming indispensable for trend analysis. But they are tools, not replacements for judgment. AI can scan thousands of assets in seconds, identifying patterns that the human eye might miss. It's like having a team of analysts working for you 24/7. The key is to combine AI speed with human intuition and ethical judgment. Use technology to find the trends, but use your wisdom to trade them. Let's see this in action with our final real-time case study. We'll look at how these decisions are made under the pressure of a live market. In this real-time example, news headlines were bearish, but the chart showed clear accumulation. The disciplined investor waits for the chart to speak. As the sideways range persisted, smart money was slowly entering. This is the quiet before the storm that professional traders look for. Then comes the breakout. Volume surges, price cleared previous resistance, and the new uptrend was born. This was our signal to commit capital. As the trend gained momentum, the masses joined in. This is where we start to tighten our stop losses and prepare for the eventual exhaustion. Finally, we hit the distribution phase. The trend became parabolic, and we exited our position as the early warning signs of reversal appeared. Before we wrap up, here is my top expert tip: the 1% rule. Never risk more than 1% of your account on a single idea. It's the secret to longevity. One of the biggest traps is confusing a healthy pullback with a reversal. Don't let a minor dip scare you out of a major winning trend. Think of it like a hiker stopping to catch their breath. They aren't going back down, they're just prepping for the next climb. Relying too much on lagging indicators is like driving a car while only looking in the rearview mirror. You'll see where you've been, but not where you're going. A common question: when should I take profits? I recommend using trailing stops. This allows you to let your winners run while locking in gains. Don't try to time the exact top. Instead, harvest your crops when the trend shows clear signs of exhaustion on multiple time frames. Even the best trend identification won't save you without proper risk management. This is the bedrock of professional trading. It requires the discipline to wait for the trend to confirm rather than trying to predict the next move. Stick to your process, not your emotions. So, before you place your next trade, go through this checklist. Is the higher time frame aligned? Is there volume confirmation? If yes, you have your edge. Mastering trend recognition is a journey, not a destination. It requires constant learning and the humility to listen to what the market is telling you. If you found this masterclass useful, hit like and subscribe for more market insights. Until next time, good trading.